Hey everybody, Chris Pulver here. Welcome back to another segment of the Pulver Report, where we trade to be profitable, not perfect. Hopefully you had a chance to check out last week's video on the Pulver Report. We talked about monetary policy, inflation, deflation, raising and lowering interest rates, and just how influential and impactful central banks can be. So I thought for today's Pulver Report, let's talk about another very powerful force in the financial markets, the hedge fund. All that and more on today's Pulver Report. You might hear the hedge fund phrase tossed around frequently on financial media outlets. Maybe hearing the phrase hedge fund makes you think of one fund, or maybe even one person. So let me drop a few names on you. Warren Buffett, Carl Icahn, George Soros, Jim Simonds, Bill Ackman, Ray Dalio, Ken Griffin, not the baseball player, that's Griffin, and David Tepper. How about Rennaisance Technologies, Tiger Global Management, Berkshire Hathaway, Bridgewater Associates, Scion Global, TCI Fund Management. Do any of these ring a bell? Because we're talking about big money. Fact, the top 10 hedge fund managers take home an average of $1.3 billion per year. And just in case you forgot what a billion is or how large it is, 1 million seconds is 12 days. 1 billion seconds is 31 years. Okay? A trillion seconds, 31,688 years. It's crazy to think how numb we are to these numbers now because they are truly astonishing. The hedge fund industry manages over $3 trillion in assets. The hedge fund community is considered smart money, the gurus, the big fish. And this is why we had such drama this year in 2021 with Wall Street's bets, GameStop's, these massive squeezes, because essentially we had this revolt from retail investors, mainstream investors, with nothing to lose, taking on these funds that were short certain stocks. So with $3 trillion under management, do hedge fund managers, do hedge funds make a lot of money? Well, when the average top 10 hedge fund manager, just one person, makes a salary that's sometimes 3 to 4 times larger than an entire company's revenue, I would say yes. So how do they make this type of money? We typically see a structure that is 2% asset management and 20% performance fees. And this is on trillions of dollars in assets. So that alone adds up pretty nicely. The 2% asset management fee is this small percentage of total assets under management. These fees are paid out monthly, regularly, quarterly, throughout the year. But the industry standard is 2%. Sometimes it's lower, sometimes it's higher. Depends on total assets, depends on client agreements. The asset management fee is applied to the firm's expenses, salaries, overhead, to keep the lights on. Okay, the 20% performance fee is calculated from the profits that are generated. So provided the hedge fund is actually helping clients be profitable, beating the markets, beating the benchmarks, they earn a nice little percentage. Now, even if they are unprofitable, there's still a 2% asset management fee to keep the lights on. And just in case you start feeling bad for a moment about hedge funds not making enough money, let's talk about one fund, one basic fund with $1 billion under management. 2% of $1 billion is $20 million. So even doing poorly in performance or losing on the trading year is still putting money in the firm's pocket. And I'm pretty sure that even after a losing year or flat year, there's going to be encouraging emails, PDFs, everything to the client talking about these optimistic gains around the corner. And so some of us might think, are hedge funds doing things that we can't do? Are they doing things that we are unable to do? Well, in my central banks video, I actually shared a bonus of the top 100 stocks that hedge funds hold. Now, for a smash of that like button and a comment, top fund stocks, I'll also leave that link in this video. And thanks to the 13F quarterly filings with the SEC, it is now a requirement that all hedge funds must submit a report for their long positions and other investments. So if you're looking for some juicy picks, you can find long positions, put and call options, receipts, convertible notes on this SEC form, the 13F. Now notice that in some areas like short positions, cash, other asset classes like Forex and crypto holdings, they're left out. Now in fact, some funds actually ask and request that they don't have to disclose some positions to the SEC, and they're able to do that. So is the 13F a direct way for us to trade with the hedge funds? Not necessarily. Short positions are left out. It's difficult for us to actually figure out exactly what the hedge funds are doing. Now you could have a long position on the SPY and a short position on the SPY with different expirations. So maybe the fund is actually net short but the 13F would not reflect this because it's only showing the long positions. Now these 13F filings are showing domestic exchanges only. They don't have to show specifics on international exposure in emerging markets. And because these 13F reports are filed up to 45 days after the quarter ends, you might even be seeing information that could be 3 to 4 months old. So for example, if Q4 is October 1 to December 31st, and the hedge fund has 45 days after the quarter closes, we might be seeing this information on February 15th that goes back all the way into the first part of October, right? So it's not really giving us the full picture. But let's take it for what it is. The 13F filing is a glimpse into the past from some of the largest and most successful funds in the world. Now, are they going to give us some magic algorithm? Is there a crystal ball that costs $10 billion? Or are these firms actually doing the same things that we can do? Right? Have you seen the show Billions on Showtime? It's a great show. If you watch one episode, you know what I mean. Like, they're not always super ethical. They might be doing some stuff behind the scenes, but let's take a little deeper dive and show you what I mean. So this is straight out of CNBC's Buffett Watch reporting on Berkshire Hathaway's portfolio. Now, as of June 30th, 2021, the 13F filing was filed on October 16th, and Berkshire Hathaway's largest holdings included some of these stocks: American Express, Bank of America, Kraft Heinz, Coca-Cola. And those are all large, like we're talking $10 to $20 billion in value. Of 300 and some billion dollars of Berkshire Hathaway's holdings, almost a third of it is Apple. This is one of the most sophisticated funds in the world. And what are they doing? Buying and holding Apple. So what can you do? Can you evaluate the fundamentals of these type of companies on Google Finance, Yahoo Finance? Yes. Can you go right into your broker platform and start investing in these companies? Yes. Do you need tens of thousands of dollars, millions of dollars to get started? No. Okay, most brokers today, Robinhood, Fidelity, Schwab, other brokers, they offer fractional shares. Even apps do this. Acorn, Stash. You can round up your purchases to invest in companies like this. So although the allure, the mystique around these hedge funds can be fascinating, the funds are still buying the same instruments that we can, right? The high tide raises all ships and the low tide sinks all ships. Now there are plenty of factors to consider when investing. There's always risk, we know that. There's no guarantees, but fundamentally we're looking for strong companies, either with a competitive advantage, efficiencies, earning potential, real earnings, profits, cash, limited debt. These are all fundamentally strong companies. Fundamentally and geopolitically, is the world growing? Are we growing in unison? Are we growing kind of individually? Or other factions? Is it safe haven? Is it risk appetite? Is it time for a top, time for a bottom? Is it time to be fearful or time to be greedy? There's an old Wall Street saying, you might have heard Jim Cramer say it as well: bulls make money, bears make money, pigs get slaughtered. This is all relative to how traders, investors manage risk. If you're taking on excessive risk in an attempt to generate short-term gains, that's a pig. Okay? Equity management, time, patience, persistence. Tons of other characteristics are why some investors survive for the long haul while others do not. So let's recap this little summary: bulls, bears, and pigs. Okay, the bull market is when stock prices are generally trending upward. We have investor optimism, we have confidence, the economy is healthy, unemployment is low or trending lower, consumer spending is stable or high or on the rise. Overall, we have a good, positive outlook, and bull markets are built on hope and optimism. Let's flip that over to a bear market. A bear market is when uncertainty, pessimism, and fear are everywhere. That's what takes over the market. That's what takes over sentiment. We typically experience economic recessions, higher unemployment, declining or low consumer spending. And because there's this aggressive downward motion, the traits are that bears are built on fear. Now, I really like this quote: bull markets climb stairs, bear markets fall out of windows. And how about the pigs? Okay? Pigs are investors assuming a high degree of risk or completely overlooking risk entirely. And they're solely focused on short-term profits. Now, rash or limited investment decision making, limited to no due diligence. As a result, pigs get slaughtered, right? They tend to lose money and potentially a lot of it since you dig a deeper hole with these massive losses, right? The bigger the hole becomes, the more improbable it is to get out of it. So as an example, if you lost 50% on your investment, you would have to recover 100% to get back to break even. So what's the takeaway today? Yes, hedge funds make a lot of money. Hedge fund managers make a lot of money. But what they do is they work their capital. They search for the strongest and soon to be strongest micro, macro trends. And they should be doing this with equity management, responsible equity management. So is it David versus Goliath? Is it, retail trader versus hedge fund manager? Not necessarily, right? If you want to get your jabs in, you want to try to fight against the man and take on the hedge funds, then look for the short interest stocks. Look for the GameStops, the Bed Bath & Beyonds, the COVID related plays in biotechs. But as much as we might loathe and disdain the hedge funds, what they stand for, what they do, how much money they make, the fact of the matter is managing trillions of dollars and finding a way to make more of it is pretty impressive. Managing the emotions that come with fear and greed and sentiment, all the factors that make trading difficult. It's not for everybody. Okay, so even as a trader investor, we have to plan for the best, prepare for the worst. So if you like today's information and you want to apply it, you want to take a look at those 13F filings, you want to trade some stocks and options together, let me know. In the comment section, type in the word equities. I run a trading room, Equities on Demand, with my good man, Tyson Clayton, Monday through Friday. We trade stocks and options together with a ton of different strategies. You want to trade Forex, Tuesday, Wednesday, Thursday. I run a live trading room in Forex called the Flex Trading Room. Also, as an added bonus to videos like this, my Pulver Report, my newsletter, the Pulver Report, www.pulverreport.com, I'm now throwing in added bonus videos once a week with my top weekly pick. Could be a crypto, could be a stock, could be an option play around that stock, or could be a Forex trade. I'm sending out that breakdown and specifically how I plan to trade it each and every week. So to get that bonus, subscribe to my newsletter, pulverreport.com. Check it out. It is totally free. As always, appreciate the thumbs up. Please subscribe to the channel. Pass on this video. Spread the word of the Pulver Report. It's always much appreciated. Thanks for watching. Until next time, this is Chris Pulver. Happy trading and lots of profits.